Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with the Forex strategy video, and we're going to take a more of a top-down approach to the market. I want to start from a very top aspect, not necessarily a fundamental analysis, not necessarily technical analysis. I want to discuss whether we should be trading markets in a short-term manner, in other words, looking for swings that last maybe a couple of days for those of you that are more active, maybe a couple of hours, or should we be looking at the development of particularly very large trend developments, which could be underway because we are seeing a focus not on risk trends, which is incredibly stubborn and not generating much in the way of momentum one way or the other, but instead we're starting to see a market that is returning to its roots of relative stimulus, right? Manipulating a currency either passively or aggressively by adjusting monetary policy, adjusting stimulus, all right? And this is going to be a very important question because when we look at pairs like dollar-yen, I'm seeing a lot of my colleagues, I'm seeing a lot of traders out there, and seeing a lot of analysts and economists discussing the potential here with the dollar-yen breaking 100 and potentially seeing a meaningful follow-through. And there's a lot of opportunity to see this drive to the upside under the right circumstances. I have made a number of times a reference to what we've seen just in the past year, when we had the really big aggressive build-up in the dollar-yen. This wasn't just isolated to the dollar-yen, it was all the yen crosses, founded on the actual increase of monetary stimulus by the Bank of Japan. First, expectations were building that the central bank would adopt a program that was similar to the Fed's in both size and scope, and then we essentially were confirmed of that program around April. Well, once again, we are expecting another program from the Bank of Japan to kind of offset the expected tax hike that we're going to get in April. All right? And if we run by the same timetable, it might be time for speculators to start building up on those expectations. Right? This is not just a yen perspective. We have a situation where we're talking about the probabilities of the Fed maintaining its QE3 program for much longer than previously expected, with the new chairman or the new potential chairman stepping in, Janet Yellen, with a very dovish tone. We have the ECB going in for a rate hike just recently, and subsequently now we're talking about the possibility or absolutely the need of a LTRO program, which is essentially another stimulus program. All right, these are three major central banks who are in a certain degree of change, right? Whereas maybe 3 months ago we wouldn't have been talking about any of these programs, or with the exception of the Fed, and now we're talking about all three. This is something that's going to be proactive, and it's certainly going to gain prominence into the coming months. However, we do have an alternative issue. We're going into the final couple of months, or actually final month and a half now, of the trading year. And traditionally, when we enter these periods, these market conditions, we see both activity and volume or participation drop off. Here's my S&P 500, average monthly volume and change. All right, you can see the average change actually in December is the best throughout the year on average, starting since 1990. But volume absolutely collapses, right? Which is what you would expect. There's so many holidays accumulated in one period, markets end up tending to believe that you're going to have this drop in activity, and subsequently it's a self-fulfilling prophecy. People are less likely to participate. All right? So we have two competing themes here. We have a resurgence of very important fundamental drive in the relative monetary policy, but we also have a seasonality effect that is subsequently looking like it's going to curb the presence of trends, right? With maybe the exception of the S&P 500, which doesn't seem to be stopping for anything. It just continues to chop higher on a consistent basis. This is going to be kind of difficult because I do think that there is a lot of potential, particularly in the setups that we have for the euro and the US dollar. All right, the euro specifically because the ECB is talking or has just recently cut rates. All right, that is a proactive move. We have a necessary time frame for the Fed because they have their December rate decision, and we know that there is going to be a transition of power early into next year. So there's a very specific time frame here. For the Bank of Japan, we still are at least 5 months out until the Bank of Japan actually confirms that they're going to give us a new stimulus program, but we have this very recent history that gives us kind of a guidance of how we can continue to play out a very similar pattern. And I can tell you that speculators are always looking for patterns, both technically and fundamentally, and that's about as straightforward as it gets. All right. So it is a very lucrative opportunity if these fundamentals catch traction. But at the same time, I don't think it's necessarily a good idea to bet against the seasonality effects, because when you're talking about market structure, participation is perhaps one of the most important concepts that you're going to have to the activity and the momentum or direction of a market. So when I'm looking at potential trade setups, like on a dollar-yen, all right, I've laid out my dollar-yen expectations after it broke 100 in yesterday's video. I don't really think that it's going to have that really strong, prominent move. One, because yes, while we do have the Fed and the December rate decision, and which will be a quarterly rate decision, by the way, it's not going to occur in the next, let's say, a couple of weeks. All right, so that's an absent fundamental theme. Perhaps the more robust catalyst may be the Bank of Japan rate decision, which is actually next Thursday. This can, alongside the Governor Kuroda press conference, give us a more consistent time frame. So while we might not get the actual stimulus program until months later down the line, this can really feed the expectations, feed the speculation, and thereby feed the yen crosses higher. So this is a possibility, but I don't like it necessarily juxtaposed to the US dollar because of its uncertainty and its lack of time frame. I'm also very concerned about pairs like euro-yen, which have two very dominant competing themes. This one's actually at the very top of its multi-year run, and subsequently has enough opportunity here to continue moving, but the problem is that you have an ECB that's talking about easing, but you have also a BOJ that's talking about easing. Who do we go for? The more active or the second most active? That's a problem. All right, these currencies are in the same position. It's a matter of essentially currency wars, which are a byproduct of the stimulus wars. So this is less straightforward. If we do see a drop in activity, however, we can see some level of consistency in the general quiet risk bid. If the markets are expecting that we're not going to see a big surge in volatility, all right? If we expect the VIX or the FX version of that, which is flipped upside down here, so the higher this orange line is, the more restrained we expect fears to be, then subsequently we could look for a quiet bid for these capital markets, or these higher return potential markets, or as they call it, a melt up. If we do have a melt up, I would not want to go for a pair that is going to be so dubious as dollar yen or euro yen. Instead, I'd be looking at a pair like Kiwi yen. Kiwi yen actually has a very substantial rate of return. The New Zealand dollar has the highest benchmark of the majors, and subsequently its interest rate forecast is also the highest of the majors. And yet you can see that it is absolutely lagging a euro yen. It is lagging absolutely a pound yen. All right, this has better potential if we are going to see those types of market conditions. So if we do see the big fundamental theme taking root, all right, you can participate. Just make sure you choose the proper pairing. Now, I also am looking at the ECB side of things. We talked about the Fed and the BOJ in depth. The ECB is very active, and it has drawn down the euro, as you can see here, against the euro USD, the euro pound, all these other pairs. But now it's the next stage. Now we're talking about the need and persistence of follow-through. All right, will the market continue to deleverage euro as it's been built up? Because it has been built up quite significantly. because they are expecting another stimulus program, something that would in turn drive the ECB balance sheet up from its exceptionally low level, and it has absolutely pulled back to a very significant low. Here's the euro USD versus the ECB and Fed balance sheet differential. All right, so if this starts to really come back in, that can absolutely drive the euro down to because its expectations have been set a little bit too high. But what are the catalysts for that? Yes, we do have further rate decisions through the coming weeks. We will have policy officials speaking about monetary policy, but is that enough to really derive a clear and straightforward move? I don't think that we do have just yet that fundamental consistency, those expectations fully invested in markets forecasts. So we're going to have to look for individual sparks, and the docket that we have up next week certainly has a couple of themes that I think are worth our while. Investor confidence, all right. The EU-Japan and EU-China summits are going to be important for economic activity, but we really get into it right around here on Thursday when we get into the IMF offering up Spain's full bank report. This is going to tell us about financial stability and one of the most dubious of the banking system or sector banking systems. We have the Eurozone PMI, which is an updated growth forecast, and that's for November. All right, so those GDP figures we just got, this is more timely. These are going to be important indicators because they will give us an updated reading on specifically this concern, monetary policy. All right, and there's plenty of it, including the 2014 budgets, which are talking about austerity. At the same time, we're talking about recessions, and the issue will once again come back to the ECB and what it can do to fill the gap. All right. So this is going to be potentially a market-moving theme, but we need to see the catalyst for it. We need to see the conviction behind it. Euro USD, which I have a small position in from this week, I want to see it absolutely make progress to the downside. It's back at the bottom of this floor, this channel floor, but I want to see follow-through, and that requires a technical break to show that move. And then as we see potentially the dollar gaining some traction or the euro losing some of its gains, that will be based hopefully on fundamentals, and then we have something more remarkable, something more tangible, and then I will build up to a meaningful position. But in the meantime, I'll be looking at pairs like the Euro Aussie. All right, because once again, we're talking about the euro, which is looking at an easing position, and the Australian dollar, which has been significantly devalued over the medium term because of its rate cuts. But like the New Zealand dollar, its yield is actually much higher than its counterparts. And its interest rate outlook is, while still in the future, positive. All right. So I will be working with the market conditions that we have, and I'll be looking at the bigger themes. But I'm not going to try to play those big themes looking for a huge hundreds of pips, thousands of pips swing, which a lot of people sometimes do remark to me that they're looking for, because these are not necessarily the kind of trades, or at least the objectives, that fit these types of conditions towards the end of the year. If it occurs, I'll have plenty of time to build into it, and I can see the fundamentals that would drive that market consistency. But in the absence of it, I can still play it in the short term. So one aspect that is consistently at the beginning of all my trades, I like to ask myself at the beginning of the week, and I do it consistently throughout the week, is this a good time to trade medium-term or long-term setups, or should I continue to stick to those short-term trade setups? All right, and as of right now, it's still short-term. All right, so take that into consideration. You should definitely break down the market in that very big picture way, because it will help you establish what trades are really attractive at that point. All right. Because sometimes there are some really great looking long-term patterns, but if they don't have the necessary aspects for follow-through, they might not be good trades. All right? So hopefully that helps you out. I hope you guys have a great weekend, and we'll do our next strategy video on Monday.